Right. Well, that's a good segue to Eric. Eric's going to give us an overview of many of the legal issues surrounding crypto. And so I turn it over to Eric.
Great. Pull up the slides here. Okay, great. So that was a great segue from Jess into what I'm going to talk about a little bit today, which really the legal aspects of digital assets and blockchain. So if we kind of move forward here, maybe kind of go to the next slide. One of the fundamental issues with digital assets is really like, what are they, right? So there are a lot of different types of digital assets. People use a lot of different definitions and think about these in a lot of different ways. Depending on how we classify these digital assets and what features they have, it will have different sorts of regulatory implications. So just to kind of talk through this very quickly at a high level, we have this notion of a virtual currency, something that's a digital representation of value that you can use it as a medium of exchange, store value, a unit of account, et cetera. An example of that would be like a central bank digital currency. We have what we refer to our cryptocurrencies, a type of virtual currency that is essentially using cryptography to help validate and secure transactions. Some of the prominent examples out there, Bitcoin, Ethereum, et cetera. Stable coins, which are a really important part of the ecosystem. It really is kind of in many cases, the digital equivalent of a dollar or a unit of gold or another currency, where it's really something that's intended, unlike the volatility you see with a lot of digital assets, that maintain a stable value so that you have some sort of really kind of common way of interacting, and kind of you often see this paired with other sorts of digital assets as things are traded. Security tokens, which was suggested at the end, where really something it's expressly built to be a security, right? It is something that is the digital version of common stock. It's providing a right to distribution. It's providing voting rights. One of the interesting things we can do with digital assets that are a little bit more difficult to do with traditional assets is we can automate a lot of this in the smart contract and carve things up in new and interesting ways to enable enable distributions of various kinds. Utility tokens. We see a lot of talk about utility tokens in the digital asset space. This is really, regardless of the fact there is a lot of speculation out there, I hope that digital assets increase in value. Most of the time, digital assets, they're built to do something, right? They help to, they're modules of software. They have to help to enable a new ecosystem. They have some function, they provide governance, et cetera. And so what is unique and distinct from a classic security is that additional functionality that's coming out of a token. It's really been built to do something. And then it was indicated at the end, something that's kind of emerged, increasing popularity more recently, NFTs, non-fungible tokens, which are interesting when we talk about a lot of cryptocurrency and digital assets. These are really just fungible things where you can trade them, and they're not unique. A dollar is a dollar, right? What is interesting about non-fungible tokens is that these really are intended to represent some unique form of ownership, and they can really it can be anything. I mean, the kind of classic case is like an ownership of an image, a JPEG, et cetera. But because this can represent ownership of anything, it can actually represent ownership of all the other things that are on this list, right? It can represent ownership of a derivative of a security, et cetera. And so these present a lot of interesting questions. But if we move forward to the next slide, the classic question that is largely grappled with in the US are the securities laws. So whenever anything is a security, the types of regulations, how you offer it, who can offer it, what disclosures come with it, what your liabilities are all kind of keyed off of the question of whether something is or is not a security. And in the context of digital assets, that's often a difficult determination. Now, the SEC has a very broad view in terms of what potentially constitutes a security. And in some cases, that may be that everything other than Bitcoin and ETH are securities. We do have kind of long-standing tests for looking at this, but these are tests that are very old. The classic test goes back to 1946, tied to analysis of orange groves, and really kind of trying to apply this into the new world of a new technology. presents a lot of challenges. And so we've actually, as part of this process, really looked through thousands of different digital assets through frameworks like this to try to look at something where it falls on a scale in terms of the risk that something is or is not a security. But going to the next slide, and we're not going to go through all of this, right? But the interesting thing about digital assets, blockchain, and crypto is, I mean, obviously, whenever we're doing anything that touches on financial services or the financial system, that is one of the most highly regulated areas of most economies, right? The financial markets are a common good, highly regulated, right? A lot of the regulations focus on regulating intermediaries. So we think about banks, insurance companies, brokerage firms, money transmitters, different categories of intermediaries. And so a lot of the way governments try to police their regulatory objectives is say, we're regulating a bank. So you're a bank, you have to do certain things. You have to have reserves. If you are, functioning like a mutual fund, an investment company, there's certain requirements apply. If you're going to touch securities and enable transacting in securities, you have to be a broker dealer. And when we take something that's entirely new and then in many ways helps to disintermediate those traditional players, right? When it may be more efficient for me to transact directly with someone else or raise money directly from someone else, that has really radical implications for regulators and regulations that really are really continuing to play out and will play out for a long period of time as we think about how to effectively re-regulate. And so again, whenever we take anything new, as an attorney, you say take something new, you take old legacy financial regulations and you try to see how those things fit, creates a lot of interesting novel and novel legal questions and judgment calls, which people are trying to innovate and build businesses are really trying to navigate that uncertainty. So we won't kind of go through this, but it really touches almost every area of law when we're talking about digital assets. So moving forward to the next slide. This is just a snapshot. Obviously, there have been a lot of developments, but just kind of give you a sense of kind of how the regulatory environment has emerged and evolved in the US. This is obviously very SEC centric, but I think it's useful to have some sense of this. So just kind of starting off high level, we had something called the Dow report in 2017, which is really the formal shot across the bow from the SEC saying, we think a lot of these things, or maybe all these things are offers and sales of securities. 2017 was a big boom in the so-called ICO or initial coin offering. And this was really kind of the warning shot to let people know, okay, this is an area, consult with your lawyers. We think a lot of these things are securities, et cetera. That continued to play out through enforcement action, other activities over time. In 2019, after some other actions that came out, there was kind of a more formal analysis, really kind of the first time to put it in a kind of an official format rather than trying to read the tea leaves from a speech, et cetera, a framework on investment contract analysis. An investment contract is the test in the US for fuzzy things that don't fall in the normal definition of traditional securities. So that came out, got a lot of attention. Some other events as we go along the way, enforcement action launched against Ripple Labs, one of the most XRP associated with that, one of the most prominent cryptocurrencies. In 2021, we saw the direct listing of Coinbase, which was really kind of an important watershed event for the industry in that you actually had a crypto company, a prominent crypto company that was able to go through an SEC registration and become public. I played a small role in that one, but it was really kind of an important development in terms of where things were emerging. 2021, we also saw the appointment of a new SEC chairman. And then we see throughout these periods, kind of cadence of enforcement actions, sometimes rightfully focused on things like fraud, right, where people have really been harmed. Sometimes the more technical violation where the SEC or other regulators are trying to send the message that, hey, we have rules, we expect you to follow them, and we think that they apply here. BitMEX, another prominent example here, and another one where we start to see kind of more coordination, CFTC, FinCEN, SEC, some of the regulators working together as they think about how they're going to approach these digital asset markets. More recently, President's Working Group report on stablecoins. And we're going to talk a little bit about a couple of these issues, but stablecoins have emerged to become these massively large billion-dollar pools of assets, right? And this was important in that it was the first time we had kind of a more of a, call it a formal executive recognition of crypto. A lot of the kind of actions kind of have been kind of negative and kind of a comment off the cup comment here and there, et cetera. This is really important. We're saying, okay, this is kind of a multi-agency coordination process where we're going to think about what this means and how it can be regulated. So in the context of stablecoins, it's significant. The U.S. is used to controlling the U.S. dollar, right? So the U.S. controls the money supply. You see this in kind of the concern over sanctions, et cetera. There's this question and a little bit of regulatory competition here in terms of how are we going to start to regulate this? So if you have a large reserve backing a stablecoin and there's no legal regime around that, it creates concerns for regulators like, is the money, is the money really there? Is it being used in a safe way? Is it really truly a reserve? And so as you have different regulators thinking about this, the SEC may be raising their hand and say, hey, we think this should be registered like an investment company, right? Or bank saying, OCC saying, okay, we think you need to be a bank to do this, right? And so you see a lot of different kind of competition and people saying, well, I think this goes down this regulatory lane versus a different regulatory lane, but people kind of thinking about how to get it right, right? Next thing we have on this list here, BlockFi settlement, another very significant moment for regulation. This is what has become very, very popular within the digital asset space are different types of products where you earn returns, yield, interest, dividends, rewards from the use of your digital assets. So if you have, for example, you put them in an account, maybe a centralized platform will pay a reward or return for you for keeping your digital assets in a certain location. Maybe it will be an intermediary, which is then lending those to people who need to use those digital assets. That's something where a lot of the position has been that those are not subject to securities laws within the industry. BlockFi settlement, SEC came out and said, yes, we think these are investment contracts. This is regulated. And BlockFi agreed to pay a penalty and kind of go through some sort of a registration process, which is still unfolding. It's also notable in that we often think about federal regulation, but states in the United States, every state has its own version of state securities laws, et cetera. And we have multiple regulators from red states, blue states, et cetera, that are kind of active in making inquiries and undertaking activities. And then finally, and more recently, and I think there's a little bit of a positive spin to this one, executive order from Biden administration, March 2022, on ensuring responsible development of digital assets. And this is important as an executive order, not so much in that it said anything kind of new or announced any substantive regulation, but it really is kind of a regulation that there's actually real value and utility and innovation happening here that's important. Right? We need to think about the best way to regulate this and the best way to coordinate among regulatory agencies in terms of how to do that. And so a lot of people knew this was coming and thought, okay, we're a little bit worried about what this is going to look like. But actually, when it came out, it kind of was a little bit of a recognition that digital assets, crypto, blockchain is here to stay as an innovation. And we just have to figure out the right way to regulate this. And so the last part I'm just going to talk about, and we touched on a little bit about this, and this is really about kind of highlighting some of the things, certainly from a regulatory perspective in terms of market trends that I think sort of are interesting or really important. So we talked about, so a little bit about NFTs. So NFTs are significant, and actually when we talk about Web3, as Jess was discussing, what's really interesting about NFTs is they touch people in a much broader way than digital assets. So for a lot of people, the notion of Bitcoin and cryptocurrencies sounds scary and exotic and kind kind of the purview of financial traders or kind of deeply technical people. NFTs are something where it becomes part of your identity, right? So if you have the right to show something, whether it's kind of your favorite moment from some dunking a basketball, a character, something that becomes part of your identity, and so it immediately becomes retail and something that people associate with in a more personal way than something like a fungible cryptocurrency. And so, but what is interesting here is we see NFTs continue to evolve and innovate. So we see a lot of NFTs where, for example, maybe you have a piece of digital art, right? And that piece of digital art by itself, not a security, right? But then we see things where, okay, well, we'll fractionalize it. And then maybe if you purchase some of this, you're a member of an investment club, right? And then the proceeds or a royalty stream from this will start to come in. And that starts to create new securities law issues. And so this is a really interesting area, and an area where we're starting to see a lot of like bridging from different areas. I spend a lot of time in Southern California these days because of the nexus between entertainment and NFTs, right? And so this is really kind of an interesting area. Stable coins we talked about a little bit. Again, the big question here is, now that we have these giant pools of money, what's the best way to regulate them, and how should they be regulated under existing kind of regimes? Or should there be new ones? There was a recent proposal in Congress to kind of basically create a new type of regulatory regime for stablecoins, and so this is going to be an interesting one to watch, because it's really having these stablecoins at the center of an ecosystem is really important for them for crypto economy to be able to function. Yield products, we mentioned this in the context of BlockFi. Again, you have crypto digital assets competing with traditional, bank accounts, other forms of holding money securely and earning interest, and that's creating a lot of questions like how do we regulate that? DAOs, a very interesting phenomenon. A lot of this, as we kind of mentioned, this is on related to DeFi as well. A lot of what crypto and blockchain is enabling is taking out those central players, those central intermediaries, and allowing people to come together. In some cases, a DAO, distributed autonomous organization, can be more like an investment club, where we have a bunch of people, we're coming together, we're pooling our funds, and we're going to buy some iconic pieces of art. We're going to buy something at auction at Sotheby's or Christie's, and then we're going to build something around it. Or we decided, rather than having like an old notion of a company or corporation that is going to control things, we're going to decide this together as a community. And this is a way where we can govern and vote and participate and make things happen, more like an old grassroots form notion, but done on a global basis, right? And so, but it does create a lot of interesting and complicated questions as you try to put this in a normal or kind of traditional legal regime in terms of, what are people's personal liabilities or tax liabilities for participation in a DAO and how it's structured. A lot of interesting areas there. DeFi, just the high level theme there is it decentralized finance. When we take out those central intermediaries and we enable things to happen in a new way, how do we make that work in a kind of a regulated ecosystem? So one theme there, for example, if we're dealing with a bank or securities brokerage firm, they will do money laundering, OFAC checks, making sure people are not on bad persons lists. It's part of the process of onboarding customers. If you create a decentralized protocol which allows anybody to transact with anybody else, suddenly you lose that player that's playing that role in the ecosystem, which is helping to make sure that things don't go for terrorist financing and other sorts of things. When you take it into DeFi, and now we're seeing hybrids, right, where you have, okay, yes, this is a protocol that allows people anonymously to transact, but we're creating little walled gardens of people that have been verified through a third-party oracle that they're not on a bad person's list, and we don't know who those people are, but we know that they are safe. And we see this particularly now as a lot of more traditional registered investment advisors, investors want to participate in this ecosystem, but they have regulatory obligations, and they're trying to figure out the best way to navigate and do that, and kind of tap into this excitement. Things like funding loans, right? So So if you're a lender, you obviously have to source your capital, make the loans. Now people are to some extent looking at different forms of digital asset projects as a way of getting the financing so that they can make loans in various countries throughout the world. Last theme, and then we'll kind of move to Brian. And this has got a lot of attention recently, is sort of the role of cryptocurrency in potentially evading sanctions, and how that's unfolding. And so there are a lot of players within the cryptocurrency ecosystem trying to figure out, how do we navigate these kind of questions? How do we make sure that we are a good actor and perceived as a good actor while still continuing to enable the kinds of innovation and kind of free flow of transactions, kind of without kind of burdening us with a lot of these other obligations. So this is something that's really kind of coming up as people decide, well, who can I transact with? If I'm a centralized intermediary, do I have to close certain accounts, et cetera? And so this was just kind of a sample of a lot of the things that we're seeing now that are big issues. But I'll pause there. I'm going to kind of move on, but just want to give you a teaser. We could probably talk about this for a few hours. And so this is just again, kind of a snapshot of some of the stuff that's going on.
So Don, can you unmute yourself, please?
There we go. So thank you so much. There was a lot covered in there, and a lot could be covered for hours and days on end, I'm sure, right? As I mentioned, I'm a lawyer. That's kind of my side hustle. It's like on the weekends, and my day job is CEO of a space company. And but those two things kind of interacted a little bit recently, and they touch on, at least from my perspective, issue of smart contracts. And I kind of tend to see, I'm curious how much activity there are in smart contracts. They're portrayed as this great solution to like automatic payments, automatic settlements of things that happen. But I think of them a little more as kind of very sophisticated and efficient letters of credit. Something happens, you deliver something, that something else happens, and you get your money. And my example comes out of the space side. So we have a customer who was putting up a satellite on a Soyuz rocket. And you could have written a smart contract about it, but you never would have guessed the Russians would have invaded Ukraine and kind of, upset every component of who's at fault and what happens then. And so it strikes me that smart contracts still have that issue. That it's kind of like, you got to put in the right information, otherwise a smart contract also doesn't work. So in that context, has that really been adopted in a big way yet, smart contracts?
So I mean, it's been adopted to a significant extent, but it's got a long way to go, right? Yeah. Because you're right. So even if you can hardwire, if A happens, then B is the result, right? If the weather is above 86 degrees on Tuesday, then I'll pay you, this amount of Bitcoin, right? You still need, right? You need someone, an oracle, a note, someone to verify that that's in fact what happened, right?
Yeah. Right. You have a dispute about that, of course.
Right.
Yeah.
Right. And so that could be, in some cases, it could be could be a centralizing. I mean, this is how it works in the traditional world. There's, someone decides, yes, that happened, so I'll pay you, right?
Right.
Or you could, you basically, in a lot of these, you'll put it out there to the community, right? And it's kind of the wisdom of the crowd, and people are doing the right thing, right? Or a kind of a closed loop, closed system of experts, et cetera. But there's still a lot of those questions out there. And then when you get the situation where it's not black and white, right? And this was not built into, like, that does raise very interesting questions, and whether there's really an override or how that's actually going to function. So a lot of interesting questions there, and it's particularly if something on a meltdown scenario, who's responsible, and then how you unwind things when transactions are supposed to be irreversible. And
does a smart contract cover that really efficiently? Even like, is it 86 degrees? Well, yeah, but we didn't account for the fact that the other side of the party went and bribed the the weather station people, and they recorded the wrong degree, and then the contract paid out, and then there's a lawsuit over it. I mean, it's kind of exaggerated, but so, well, thank you all for that. Thank you for all of that.